Yeah.
Hello students, welcome to my class. This is Professor Vincent Usaya, and this is part 4 of chapter 7 presentation. Chapter 4, internal control and cash. A couple of issues that we need that are left in chapter 7, bank reconciliation and making journal entry relative to the bank reconciliation. Then we are going to talk about the related ratios for analyzing the performance of the company. So, now let's take a look at these facts and use these facts to perform a very simple bank reconciliation. We did one in part 3 presentation. So here are the facts. The bank balance at the end of the month is 12,720. The book balance at the end of the month 20,850. Like we indicated earlier, the two balances are different because of the three primary reasons we discussed in part 3. Number one, transactions that we have that the bank does not have, and vice versa. And number 3, our error or the bank error. So deposit in transit is 9,000. Outstanding checks, we already explained what those stuff means, 2,000. EFT receipt from customer is 100. Interest revenue on bank account is 30. Bank service charge is 20. EFT payment of water bill is 40. That is the payment that the bank made on our behalf. And a non-sufficient fund check is 1,200. So let's take a look at how this plays out. Like I indicated to you in part 3, in real life, when you are doing bank reconciliation, one of the first steps that you perform is to identify those transactions that cleared your books that also cleared the bank. You need to scratch out all those transactions or identify them because those transactions are not the reason why you have a difference. So the transactions that did not clear the bank but are in your books and vice versa are the transactions that you are going to use to perform your bank reconciliation. I also want you to know here that the bank reconciliation is being done on a piece of paper. This is not an official accounting record like journal, ledger. So we are going to talk about how to make the related journal entries in connection with the bank reconciliation in a minute. So like we said earlier, here is the bank reconciliation. We start with the bank balance. The bank balance is 12,720 at the end of the month. The book balance is 20,850. Like we said, none of these two balances actually reflect the true cash balance of the company. So let's take a look at what happens here. On the bank side, we are going to add deposit in transit. That is the deposit that we have already recorded, but the bank was not aware of it because they already sent us the bank statement before the deposit hit the bank. So we need to add that to the bank balance. Then we also need to subtract from the bank balance whatever we subtracted from our balance that the bank has not subtracted. In this case, it is the outstanding check number 204 for 2,000. So when we do the math, we have the adjusted bank balance of 19,720. So let's take a look at the book side. Ending of the month, we have 20,850. Now we are going to add to the book balance what the bank has added to their balance that we have not. Number one, the bank received $100 on our behalf from a customer. So the bank make a note of that or recorded that, but we are not aware of it until we receive the bank statement from the bank. So we need to add that $100 to our balance. Then interest revenue that the bank credited to our account that we were not aware of, we need to add that $30 interest revenue to our balance. So that's $30. Then bank service charge. The bank would not notify you that they are charging you bank service charge. The money is right there. They just take it. And by the time you see your bank statement, you see the bank service charge. So that bank service charge needs to be subtracted from our balance. Then of course the EFT payment of water bill also has to be subtracted because the bank paid it on our behalf and we have not recorded it in our books. So we also back that up. Now the non-sufficient fund, this is how that will happen. When a customer gives you check, you record the check as a plus in your books and you present it to the bank also record it as a plus in their record. Now, when the check presented to the bank or given to you by your customer goes through the clearing house and there is not enough money in your customer's account, the check is being given back to your bank, and the bank will make an adjustment for it as a minus. Now, you are not aware of that until you receive your bank statement along with the advice or along with the notice, or during the course of the month, the bank will send you the notice. Nevertheless, you need to back out the $1,200 from your balance because the bank has already backed it from their balance. So at the end of the day, take a look at what happened. We have reconciled, we have completed the bank reconciliation, and the adjusted book and bank balance is now $19,720. So that is the true cash balance of the company. Now, this is very important for you to know this. The bank reconciliation is done on a piece of paper. So there are some transactions or reconciling items relative to this bank reconciliation that need to be recorded in our official accounting books. In other words, we need to update our accounting books. As you can see, those transactions that we have already recorded, even though they are reconciling transactions or they are reconciling items for bank reconciliation purposes, we are not going to record them again in our accounting books vis-a-vis the journal, the ledger. The only reconciling items that we need to zero in on and record it in our official accounting books are those transactions that we have not recorded. Clearly, for example, take a look at the EFT receipt from the customer of $100. We have not recorded that because we were not aware of that transactions. So let's take a look at the related journal entry after the bank reconciliation has been performed. Look at what happened. We debit bank service charge for 20. We were not aware of that. That has not been recorded. Utilities expense that the bank paid on our behalf. We were aware of it, but we have not recorded it. So we debit the utilities expense for 40. Accounts receivable, we debit for $1,200. That is for the non-sufficient fund. Then we credit accounts receivable for 100. Interest revenue credit cash 1130. So here you have it for the related journal entry after completing the bank reconciliation. Now, the last issue now is, remember, at the beginning we said that the financial accounting, what we are doing for the whole semester, number one, is learning accounting rules. Number two, how to apply the rules. Number three, we also call the rules generally accepted accounting principles, or we also call them accounting standards. By the time we are done applying the accounting rules, then the end result of the application of the rules is the production or the preparation of financial statements, vis-a-vis income statement, balance sheet, statement of cash flows. Now, we said that the financial statement, there is a lot of valuable information in the financial statement that is used by internal and external users for different decision-making purposes. So that is number three. Number four, the information is being communicated to the users. And number five, we analyze the information. In other words, what does the number really mean? Okay, accountants are in the business of information. We produce a lot of information. A lot of people are not aware of that. A lot of people know that we crunch numbers. The number crunching is not an end in itself. It's a means to an end, and that is information. So at the end of the day, the fifth issue in terms of what we are trying to accomplish in this chapter is to come up with different methods or techniques of analyzing the numbers. And one of the techniques that we use is ratio. Here in this case, we are using the cash ratio to evaluate how liquid is the company. What is the company's ability to pay his debt as quickly as possible? Remember previously we talked about current ratios, and we said that current ratio is calculated by dividing the current assets divided by the current liabilities. The higher it is, the more likely that we are able to pay our current liabilities. But in this case, we have another ratio called cash ratio. Cash ratio is specifically cash. So we are dividing cash by current liability. What are we doing here? The higher this ratio, the more likely that we are able to pay our current liabilities. Here we are establishing relationship between cash and current liability, unlike current ratio where we establish a relationship between all the current assets and the current liabilities. In this case, it's strictly cash. So this measure or this ratio measures our ability to pay our current liabilities as fast as possible. So here you have it for chapter 7, internal control and cash.